All right, everybody, welcome back to the next video in the advanced section of this free course. All right. And in this video, we're going to talk about algorithmic price levels. So, just so everybody knows, the algorithm itself, all right, like we talked about in the very beginning of the course, is based off of the Chicago Mercantile Exchange. All right. They built the very first algorithmic model or algorithmic market maker. All right. And to keep things simple, um, every asset that is managed and ran by an algorithmic market making model utilizes the foundation that the first algorithm was designed off of. All right. And in this foundation, there are what you call algorithmic price levels. All right. And these algorithmic price levels are the open prices of certain candles. All right, certain times. All right, the algorithm, all right, is based off of time. Let's look at this here. The algorithm itself is based off of time and price. All right, and we know that why? Time. There are certain times of the day that are better to trade than others. All right, price. The algorithm or the market making algorithm has to give you what? A price to buy and sell an asset at. All right. So logically, if you put the two together, there are certain times of the day, all right, where price is very sensitive at. All right. There are certain price ranges, like we learned with pre-market. All right. But there are also certain price levels that are sensitive and can be utilized to help train, to help frame trades, to help you understand if price is going to go higher or lower or not. All right. Or potentially give you an entry off of. All right. We'll take a look at that. Let's take a look at that. So first, before we go in there, let's learn about the algorithmic price levels. And to learn about that, we have to understand about candles. So if we have a bearish candle, like so, let's imagine this is a bearish candle. We'll make this red candle, make this red. This is a bearish candle here. All right, let's clone this one here. Boom, boom, boom. And then this candle over here is going to be bullish. All right, it's going to be bullish. All right. And don't worry about the wicks. Sometimes we have wicks. We don't worry about that. If a candle is bearish, then what that means is that price opened here and then it closed. So we get to open here and then we closed here. We might have a wick. We might have a wick. We might not. All right. The wick just means price used to be there. But this here, where the body is at, if it's red, that means the candle price opened here and closed here. All right. So that's the open of the candle. What price, what time and price we opened at. So at a certain time, this candle at a certain time opened here and at that price level. And at a certain time, this candle closed and at a certain price level. And we call, I say a certain time because each candle can be different. Like right now, I'll show you on this chart here for this example. We're on the 5 minute time frame. So in 5 minutes, every 5 minutes, a new candle opens and closes. All right. So this is the open price. That's where we opened at, where we started, and the close price is where we closed. If we close below the open price, it's going to be a red candle. This wick, this just right here is the high. All right, this wick down here is the low. All right, so have you ever heard the concept of open, high, low, close, or high, open, close, low, whatever the case may be? That's what that is right there. The open, the close, the low, the high. Now, if it's green, that means we what? We opened down here and we closed above the open price. That makes a candle green. We opened lower, closed higher. Or all right, whether we have a wick here, that's just the what? That's always going to be the high, and we have a wick down here, that's always going to be the low. All right, that is how these candle bodies are structured. All right, we don't really care about the high and the low. We care about the body of the candle, where it opened at. We care about the open price. All right. The open price is you're going to be your algorithmic price level. All right. There are certain ones that are key, and I'll walk you through. There are four. There are four. There are four. All right. The open of the day, we call it daily open. All right, the daily open, which changes depending on the asset you're trading, because some assets don't always trade open at a certain time frame. Some open differently. For example, your indexes, your commodities are going to open different times than forex pairs. So your daily open, all right, 2 a.m. Central Standard Time, all right, 4 a.m. Central Standard Time, all right, and the fourth is 8:15, the end 8:15 a.m. Central Standard Time. All sound familiar? They should. 2 a.m. to 4 a.m. is London. Remember that? Remember that? 2 a.m. to 4 a.m. is London. 4 a.m. to 8:15 is what? Pre-market. So the start and the end of these price ranges, these, all right, are also what? Algorithmic price levels. All right. Let's go take a look at them so you guys can actually see exactly what I mean on the actual charts. All right. So here we have the NASDAQ 100. All right. Here we have the NASDAQ 100. Let's scoot this over some more, stretch this out a little bit. We got the NASDAQ 100. All right. So we have here. All right. Let me get this here. So the open of the day. All right. The open of the day is right here. This candle right here. This green candle is green, which means it opened lower and closed higher. So this green candle is the what? That is our first algorithmic price level. All right. Boom. Now look at that. Look how price what came down, closed above it, came back, rejection, and bought off of that. Beautiful. Look at this here. All right. This candle here, last bearish candle before we what? Broke structure. Broke that high right there. Price closed below it right there. We closed below it once, closed below it twice. Price pulled back off of this price level into this what? Into this fair value gap to do what? To continue selling. It's crazy. It helps you frame trades. All right. We then closed back above this price level, came back, wick, wick. That's a doji right there. Buy. Look at that buy. All right. So that's the opener today. All right. 2 a.m. Let's go look at 2 a.m. The start of London. Here it is. Here's the 2 a.m. candle. The high is a bearish candle. So it means the high of the candle, that's where we opened at right there. Let's mark that. Crazy. Look, when we bought off that doji right there, what do we come to? Right to 2 a.m. open price. That's the 2 a.m. open. This is the daily open price. This is the 2 a.m. open price. We came right to 2 a.m. and sold right off of it. All right. These algorithmic levels are also there to help you frame potential take profit levels as well. All right. Areas that you can take profit at. All right. Let's go look at the next level. 4 a.m. The start of pre-market and the end of London. Here it is. It's a bearish candle, which means we what? We opened up high and closed low. So let me get the cursor on there and boom. Look what happened in market open. Shot down, rejected 4 a.m., closed back above 2 a.m., and was gone. All right. And then last but not least, 8:15 is bearish candle. So we'll mark the high right there. All right. Cool. Those are your four price levels that you want to focus on. All right. We're on a 5 minute time frame. It's easier to put them on the 5 minute. You can go on the 5 minute, 1 minute, whatever the market might typically mark them on the 5 minute. But let's look at this trade real quick. All right, look at this lowest 5 minute candle inside of pre-market. We had a CSD closed above it. All right, so guess what? I'm gonna mark that candle. I'm gonna mark that candle, and that candle is very important because look, it has 4 a.m. inside of it. The 4 a.m. open price is inside of that candle. All right. And we come down to the 1 minute time frame. All right. Now we come into the 1 minute time frame here, and we can look at the trade. Look at this. All right. Price did what? Well, actually, go back to the 15 minute. 15 minute time frame. Go back and look at the 15 minute time frame. You can see before the 8:15, before pre-market was open, that fair value gap was filled. There were no fair value gaps. So it's a what? It's a balanced price range. All right. So we got a balanced price range. So now what are we waiting for? We want price to do what? We want price to come out in one direction, come back in and give you a buy. All right. And look what it did. Balanced price range, like we learned in the first video in the advanced training. Price came out of pre-market on the buy side. Price dropped back in to that lowest 5 minute candle. Boom, closed below 4 a.m. Then boom, look at that. That candle closed back above, and that's the CSD right there. It closed above that bearish candle, and it closed back above 2 a.m. I'm sorry, 4 a.m. Oops, wrong way. All right. We get in next candle. Next candle, you see a wick pulls back to retest that candle. So we even had a retest. Let's just say we put it just a little bit below that last candle there. And we aim for the what? Previous high. Aim for the previous high. Look what happened. It's out of there. Easy trade. Easy trade. Lowest 5 minute candle with what? Additional confirmation. We came back in and CSD inside the what? Inside of the lowest 5 minute candle. Pre-market is balanced. It came out first. So we want price to come back in to buy out. So that's first on the model. It came back into the lowest 5 minute candle. Had a CSD right around what? 4 a.m. inside that what? 5 minute candle. Buy. Easy. Easy. So that is how you can use those algorithmic price levels. All right. Um, and how they can help you to identify and help you with, and guiding you to catch trades. All right. And frame trade setups. All right. So we'll look more at those a little later on, but just want to give you a little tidbit of how these algorithmic levels can be used. Hopefully you learned something valuable in this video. I'll see you in the next one.